personnel
Lend me
people
your-
and others.
lend me your ear.
Welcome to this pre-council. I assume like other meetings in the city hall, this is governed by the Open Meetings Act, LB 898, which is posted at the rear of the room.
Yay.
Mr. McDaniel, I think you're going to teach me some things. Would you please start?
Thank you, council. Appreciate the time this morning. We have the police and fire pension actuarial valuation as of August 31st, 2018. I have with me Pat Beckham and Brian Hogue, our actuaries from Kavanaugh McDonald. They will be presenting the results and taking you through the PowerPoint to kind of explain the highs and the lows of the pension valuation. I'll let Pat and Brian go from here, and we'll entertain questions at the end or throughout, whichever is your pleasure.
Thank you very much. Welcome.
Thank you. It's good to be back with you, and it's kind of amazing. We're generally only here once a year, but it kind of rolls around pretty quickly. As Doug said, we are here to visit with you and brief you on the results of the August 31, 2018 actuarial valuation for the Police and Fire Pension Fund. So you do have to mentally kind of roll back almost 6 months to 8/31 when we talk about things like, you know, return and what happened in that last 12 months. I'm going to kind of kick it off and kind of walk you through the very, very high level. Brian will walk you through more of the details, and then we have kind of a new actuarial standard of practice, just sort of the professional guidelines that govern actuarial practice, and there's sort of a new one coming up actually in your 2019 valuation, but we wanted to wet your whistle with it this year. So I'm on page 2 of the presentation. Just a reminder that funding a pension plan is a very, very long-term obligation. And we need to always keep that in mind, that the time frame, we were kind of joking about actuaries and meteorologists and their predictions and the accuracy thereof. The difference is we know right away if the meteorologist is right or wrong, but for us, we have the advantage of saying we have to wait 30 years to see if our assumptions were right or wrong or how close they were. So again, our lens is very much long-term, and we keep that in mind in all of our work. The benefits that will be paid in the future are the obligations or the liabilities of the system. Challenge there is obviously we don't know exactly the amount of those, when they'll start, how long they'll be paid. They're contingent on people living. So we use actuarial assumptions to help us estimate those future benefit payments, and then that drives the liabilities, which of course drives ultimately the contributions to the plan. There's going to be variability from year to year, because even if they're right, in the long run, 30 years, it will not unfold exactly every year. And if you think about the rate of return, we could be right at the end of the day. It's effectively a 7.5 compound return over the next 30 years, but it won't be 7.5, 7.5, 7.5. What we're trying to do is monitor the funding progress, sort of the glide path to fund this plan over time. Every year when we do the valuation, we capture the actual experience for the last 12 months, kind of recalibrate and set the glide path going forward. And it's that consistent monitoring and adjusting that keeps the plan's financial health in check. So we do the valuation, we get information on the funded ratio, which is assets divided by liabilities, the unfunded actuarial accrued liability, which is the difference in those two numbers, and then probably pretty importantly to you guys, the contribution amount for the following fiscal year. So page 3, the valuation is what we call a snapshot or a point in time measurement. So again, we're stopping everything August 31 of every year. We're looking at who the people are in the plan and the benefits that are expected to be paid to that group in the future. We're measuring assets on that date. If we measure a different date, we get a different answer, but again, it's that consistent measurement, 8/31. It's kind of when you go for your physical checkup to the doctor every year. That's the kind of information we're gathering on the health of the plan. Again, we're using a lot of assumptions. Those are intended to be a best estimate. There are certainly other reasonable sets of assumptions that could be used, and if we use those, we would have different numbers than what we're presenting to you today. So there's not a single right answer. There would be clearly a range that would be consistent, that would fund the plan over time. Again, we're going to expect variations. Brian will talk to you, Again, we make assumptions about retirement, salary increases, termination of employment, death. All those things don't happen precisely, and we measure that from year to year. What was the actual experience compared to what was expected? Again, the results of this valuation, the August 31, 2018 valuation, is used to set the contribution for your fiscal year end 2020. So page 4, just a very high-level glimpse comparing the 2017, the 2018 valuation. Third line down, the unfunded actuarial accrued liability, 52.9 million in this valuation, down from 54.9 million last year. Again, Brian will look through the components of that change with you. Again, the same information, assets divided by liabilities is the funded ratio. That increased from 81 to 82%. Isn't really a magic number, but in Nebraska, 80 is a special number because if you're above 80, you don't have to visit the legislative committee in the fall to talk about your plan's funding. You get kind of a free pass. So it's a good thing to stay above 80. We're all happy to see that go to 82, yeah. And then the contribution, again, Brian will go into a little bit more detail on what these various components are, but the actuarial contribution rate decreased, again, as a result of the unfunded liability decreasing. So it's down a little over 50 basis points to 23.75. Employees are contributing to the plan as well as the city. And again, that's a blended contribution rate. That's why it looks a little odd, 7.23. We have a slide that'll show you we've got different groups of people contributing different amounts. So it's a blended rate. Bottom line, the employer actuarial contribution rate decreased from 17.08 in last year's valuation to 16.52%. So it's good news. And I'm going to say it so Brian doesn't get a chance. So I've been doing this a long time. So the rate of return, the assumed rate of return is 7.5, and the actual rate of return for year end 2018 was 7.54. That hardly ever happens, so put a sticker on the calendar. I think that might be one time out of maybe 30 years that's ever happened. So
Comment about forecasting and weather just a minute ago?
yeah, pretty good, right? Yeah, I won't this year, trust me. Never seems to have worked that way. So Brian will kind of walk through the details. Again, if you have questions, feel free to jump in.
Okay, so like Pat said, we'll get into a little bit more of the details on how we came up with these contribution rate numbers for this year. So when we're looking at the assets and liabilities, the liabilities side really starts with the data that we collect. Who's in the plan as of 8/31 for this plan or for this system. So we compare the current year 8/31/18 versus 8/31/17 for all the different groups of members within the plan. So like looking at your actives, you were up 11 people from last year, a couple percent. We have drop, inactive, vested, people that have left that will be due a benefit in the future that were up a little bit. Refunds due, these are kind of just a lag of people that will be paid out their contributions, but they just kind of haven't hit the assets yet. And then the last line is your retirees, disabled, beneficiaries, anybody that is currently receiving a payment. So really there's not much change, real stable population from last year to this year, and that'll kind of be a theme throughout, is things are pretty much in line with last year, which makes our job a little bit easier as well. On slide 6, we look at the active members in the plan and kind of come up with that effective contribution rate that Pat was talking about. So we have 4 different groups of police members and 2 different groups of fire, all over there on the left column, and then the number of people that are, or number of actives that are in each of these groups. You see the plan A that's the current plan, so as people retire, terminate, the old plan and plans B and C will eventually go away and everybody will be in plan A. But you can see that the plan A for both the police and the fire group, their employee contribution rate is 8%, and they contribute that 8% throughout their whole career. Whereas some of the other plans, like Plan B and C for police, or 7.6% or 7%. But once they hit a certain amount of service, they stop contributing. So if you look over on the far right column, you'll see that the effective rate for those groups is 0, whereas with Plan A, it's still 8%. So really, the bottom right number is what we're looking at. So 7.23% is the effective contribution rate that members are contributing to the plan, and this will continue to increase as we lose members from the old plan, Plan B and C, up until we get to 8%.
Do you know what the numbers were last year on those?
Yeah, so on the very last footnote,
There's a
we
footnote.
had the last few years. So last year was 7.2, 2016 was 7.06, and then 2015 was 6.88.
I'm sorry, I was thinking of the numbers in plans B and C. How has that dropped from last year? So we see how fast
Oh,
those are declining. The 24 police and the 22 fire.
I don't have those numbers.
It would be in probably the presentation
We'd have
from
to-
last year,
yeah,
which
we'd have
probably
to
none
pull
of us
out-
have.
we'd pull up last year's presentation.
You're not here prepared?
I guess not. Note to self.
We prepare for most questions, but
It didn't change much.
Okay. But that should keep declining.
Yes, it will continue to lose, or the count in plans B and C will continue to decline. I want to say it was low 20s for Plan B and police, but again, I don't have those exact numbers from last year.
Right. Eventually, it's headed to 8, which is the good news.
The rate, yeah. On slide 7, talk about the assets a little bit. So we use what we call an actuarial value of assets. We don't use the market value directly in any of our calculations. We use this actuarial value, which is a smoothed value, and this is very common with public plans. It's really to eliminate some of the volatility with the contribution rate, dollar amounts, and you'll see this on the next slide. It's your smoothing rate, or your smoothing method, is a 5-year smoothing where we recognize 20% of the gains and losses in assets each year. And so, as Pat said, we were 7.54, so a very, very tiny gain on actuarial assets this year. That will be smoothed in over 5 years. Whatever happens this next year, again, will be smoothed in over 5 years. But again, it's very common and helpful when looking at contribution rates. And you kind of see it a little bit here on this chart. So on slide 8, we have a graph where the blue line is the market value rate of return, the red line is the actuarial value rate of return, and then the green line is your assumed rate of return for that year. And so you see the blue line bouncing around quite a bit, or is it down to minus 16% in 2009 and then jumps way back up, whereas the red line a lot more smooth going through there. And again, that helps your contribution volatility from spiking around. If we were using the market value, you'd see lots of ups and downs. It's hard with budgeting.
When we say the 5 years, would that include, is that 18, 17, 16, 15, 14?
So are you saying going back to 14?
We use
as
the
well?
5-year smoothing, so which 5 years would be smoothed this particular report?
Yes, going back so you smooth the 20% of the return that we had in this past year, or what happened through 18, and then each of the prior 4 years. So 17, 16, 15, 14, yeah.
So that's a rolling.
Correct.
Yes.
So after this valuation will be the last 20% we recognize for 2014. Next year's valuation, 2014, will be done and we'll recognize the last 20% of 2015's gain or loss.
The reason I ask is in 14, we had that 16.5% gain versus, then in 15, we had the loss. That was
Yeah, and once we get to the 5-year projected contributions of the budget, like you kind of see the rates bouncing around a little bit, and that's really working in the smoothing or the gains and losses from the last four years. So on slide 9, we look at what the assets did year over year. So from August 31, 2017 through August 31, 2018. We have the market value in the first column and the actuarial value on your second column. So all the cash flow information will be the same between both. So your contributions, put in about $11.4 million in contributions to the plan. Paid out a little less than 16 million in benefit payments to those members that are receiving payments. About 400,000 in administrative expenses, and then the net investment income, or what the plan earned, our market value is about 17.5 million. And prior to this year, we had some deferred gains and losses, or again, with our smoothing method, we had some good news that will be coming through, like you pointed out, the 2014 big return. And so we had 18 million flow through on the actuarial value of assets. So as of 8/31/18, about 245.9 million on market value, but then 243.5 on an actuarial value. And this is the asset value that we'll use in all of our calculations, whether it's the funded ratio or coming up with our contribution rate. We use the smoothing, or the smoothed assets, or the actuarial value of assets. So looking on slide 10, the funded status of the plan, again, comparing the current year and the last year, so August 31/18 versus 17. Liabilities up a little bit to 296 million. The assets up from 230 to about 243 million. And so our unfunded actuarial accrued liability last year was about 55 million. We're down to about 53 million this year. And again, the funded ratio, as Pat mentioned, went up a basis point, so we're at that 80%. Kind of looking back a little bit farther, just a historical look at the funded ratio. Going back to 2001, we were about 100% funded from 01 to 08. Then we kind of know what happened in 2008. The Great Recession really hit us hard, dropped down. About 2013, we were right at 70%. A couple things to point out here: in 2014 and 2015, the drops those years, we had a change in our assumed rate of return, and so that contributed to the drop in the funded ratio. Kind of going back to our basic actuarial formula: contributions plus investment income equals your benefit payments and expenses. So if we're earning less income, we need to put in more contributions those years. When we had the big jump up to 80%, that was when the COLA pool was merged with the general fund. So again, we could increase our assumed rate of return because we weren't taking money off the top of that. So there's kind of big jumps in here. A year-over-year look at the change in the unfunded liability. I mentioned at the beginning of the year, we're September 1, 2017, at about 55 million in unfunded liabilities that would have to be paid off in the future. We're at 53 this year, and so some of the things that happened, we paid in a little more contributions than the actuarial required amount. Our amortization method is a systematic method to pay off this unfunded liability, and that increased our unfunded by about $500,000, and this is to be expected. So the way, we'll talk about this a little bit further, but your method of paying off your unfunded liabilities actually will see an increase in that, and at the very end it gets paid off. So that was $500,000. Investment experience was about $1 million gain. Liability experience was a little over $1 million gain as well. That was mostly due to salary increases that were lower than expected, and some other experience with kind of the total payroll, how that moves, some timing on interest and things. So overall, the unfunded liability came down, which is always a good thing. Slide 13 is just really another way of looking at that funded ratio chart. So this is the unfunded liability in dollar amounts. So again, from 01 to 08, hovering right around 0. You see 9, 10, 11, 12, 13, kind of systematically stepping up as we're phasing in those losses, those asset losses. 14 and 15 had that jump from the discount rate decrease, and then the big drop in 16 was when we merged that COLA pool. So again, just another way of looking at the information in graph form.
Do you recall which years we went from 4 to 5 year smoothing, and there was a second change too?
I don't recall that.
That was before Kavanaugh McDonald assumed actuarial services for the plan. I think it's a 4 to 5 year change.
Was that in '09 or so?
I'd have to look.
And we had one other change too, the amortization, we increased the length, did we not?
Yeah, I think we changed from 4 to 5 years on
Smoothing.
smoothing.
And did we go from 20 to 30 on amortization?
We went from a open term repeatedly resetting to 30. And then I think it was 2 years ago with the funding policy, we started at 28 years with a closed term. Brian and Pat could help out more with that, but that's my recollection.
I was thinking we actually increased though the number of years to 30. It had been like 20 or something.
Yeah, right after,
At the same time we did the smoothing.
right after the 2008-9 time period, we changed, because basically we weren't underfunded until then. We had used 10 years as the
Oh, that's right, 10 to 30.
period, and then went up to 30 years after the 2008-9.
I mean, those were, especially that amortization was significant.
Yeah. That was in the 2009 valuation was the first year, it was 30. And I'm sure, well, I'm not sure, but I would suspect that's related to the big investment real loss and the impact of that.
Thank you.
Okay, so we'll get into a little bit of how the contribution rate is determined. So there's really two pieces that we need to add together to get your total contribution rate. The first is what we call normal cost, or really the ongoing cost of the plan or the system. These are for your active members on the date of the valuation, money that will pay into to basically account for the benefits that they're earning. The other piece is that unfunded or liability piece. How are we going to systematically pay that off? And that's what we were just talking about a little bit. These are, we'll show on the next page, there's kind of layers. Every year we have gains and losses, as Pat mentioned. People won't die when we expect them to. People won't retire when we expect them to. So we have some mismatch there, and every year we'll create a new layer with that. And we pay those off as a % of payroll. So similar but different to like a house mortgage, whereas every year you're paying the same amount on your house to get it paid off in the future. We're paying off this debt instead of the same dollar amount every year as a same rate of payroll. So we expect payroll to increase every year as we go. So that means our payments will increase as we go as well. But in theory, it should stay the same % of payroll, even though the dollar amounts are increasing. Okay. So on 15, we should kind of show how this works. So there's really 3 different lines, and these are your different layers, what we call them. The first one is the biggest base. This was your 2016 unfunded liability base. At the time we set this up, there was 28 years, so as Paul mentioned, we're kind of 2 years into it. The first column is the original amount that it is, then we have the payments that are remaining, so every year we pay off a portion of this. The outstanding balance in that third column, if you add all those up, that $52.9 million down at the bottom, this is our unfunded liability as of this valuation date. And then the contribution that we have for the current year to pay off each of those bases. Next year, when we come and we talk to you, will be a 2019 experience base, because we're not going to hit the 7.5. We're not going to be exactly spot on with the liability or expecting when people terminating things. So there'll be another experience base that we will be paying off over 20 years, and each of these bases will be one less. So we add up the annual contribution for each of these 3 pieces, the $3.4 million. We take that divided by what our expected payroll is, and that's where we come up with the 7.23% of payroll to pay off this unfunded liability.
Just one other comment on that. So when you look at that annual contribution, this goes back to the way that unfunded liability is being financed. Those dollars will increase 3% next year and 3% the next year. So there's that built-in expectation that payroll is going to increase, but the payments are going to increase either way. So if payroll doesn't go up 3%, the rate goes up. The dollars are the same, but it is a sort of a back-end loaded approach, but it's because we're trying to level out the cost of these benefits over a long period of time.
So put some numbers to that then next year on these figures. So the amortization would go up, and I know these are
These
estimates.
payments would go from 3.39 to 3.49.
Sorry?
From the 3.39 million to 3.49. And then, as Brian said, you'll have a new base for 2019 that'll either be a gain or a loss. That'll adjust it. But I guess the important thing we want to make sure you understand is that these payments are all scheduled to go up 3% per year, because that's the expectation that payroll will, total covered payroll will grow, because wages are going to go up in general. All right.
Makes sense. Okay, so on slide 16, we look at the total contribution and all the pieces for it for the current year and the prior year. So with the first column, evaluation date, August 31, 2018, we're setting this the contribution rate for fiscal year beginning September 1, 2019. So there's really a 1 year lag. We do the valuation and the contribution rate isn't in effect for another year. So last year's valuation, the far right column, is set the contribution rate for fiscal year beginning September 1, 18 up through August 31, 19. So just keep that in mind as well. So the first line, the normal cost or the ongoing cost of the plan, 16.5%, same year over year. The member contribution rate, this is what the effective rate that the members are paying into the plan, which helps offset the city's contribution. And again, that was at 7.23 effective rate that we will continue to see climb towards the 8% number. So the unfunded contribution rate, that's 7.23%, and I promise you it's just a coincidence that the 7.23 UAL rate and the member contribution rate are, it's not a typo, those are the same this year. So the employer contribution rate is 16.52% for this valuation, down from 17.08 last year. We have our projected payroll and then the actuarial employer contribution amount down at the bottom, which is about 8.4 million this year. So even though our rate came down from the 17 to the 16.52, the expected dollar amount is increased from last year because of that payroll increasing.
So adding those all together then, with all the employer-employee, that's 33.04% contribution. And if you take out the employee, 16, and the city.
So total, I think is 23.75%,
Yeah.
and then the reduced for the 7.23 that the employees are effectively contributing to get to the 16.52. Slide 17, just look at a graph of the kind of historical contributions. So the green bars going up are what was actually contributed, and the blue line is the actual determined contribution amount. So pretty spot on. There was 1 year in 15 that there was a little bit more of a gap that the city didn't contribute, and I think that was right before the COLA pool was funded, and so we kind of knew that it was going to drop the following year, and so it wasn't put in. But look at 10 years, and then the next slide on 18. Just because I like numbers, I'm going to give you all the numbers that are behind the graphs as well. So as I mentioned before, 8.4 million for fiscal year beginning September 1, 19, up a little from the prior year, 8.3 million, and you kind of see the comparisons going back 10 years. Then slide 19 is, I'm guessing, what most people care about here, and this is the 5-year budget estimate. So we have fiscal year on the first line, 19 to 20, and then each year going down past that. Kind of walk through this a little bit. So the employer normal cost rate in the first column that 9.29 that we saw a few slides ago. And as you go down, this continues to decrease. And really what the reason for that is that employee contribution increasing towards 8%. So in theory, this would stay the same, but as your employees put more of an effective rate in, you get more and more people paying the 8%, the employer normal cost rate comes down. The next column, the UAL or the UAAL contribution rate, the 7.23, this is where the asset gains and losses from the prior years are smoothed into this. And so we see a jump in the second year. Again, that was that 2014 gain dropping off, and so we're smoothing in losses that year, and it kind of bounce around, and then afterwards we'll kind of smooth out. So your total ADEC rate, the amount, we add in administrative expenses, and on the far right column is the employer contribution amount estimate for the next 5 years. So again, we have the 8.423 million for fiscal year 19 to 20, and going up 8.787, and this is pretty much spot on with what we had last year. I think last year's estimate for 19 to 20 was 8.434 million. So don't hold us to that. It's never going to be that close again, but it's
Not until you're ready to retire.
Yeah. But it was good news that it was basically no news.
Now the current year we were at 8.3, so we had about a $90,000 increase from last year to this 8.423. Then you jump almost, 270,000, 80,000. Then it starts declining more to 50. And then I guess the last year, though, it's another almost 200,000. Can you explain some of the rationale behind that? Or?
Yeah, so really what this is your asset smoothing method, recognizing 20% of the gains and losses from the prior years. And so going back to, that is 2015 here, so there was an asset loss in 2015, and so when we're smoothing in that loss, we're going to, well, basically in 14 we had the asset smooth gain drop off, and so we see a big jump because we're no longer smoothing in those gains. And then after we, in the third line, 21 to 22, that big asset loss that we had in 2015 comes off, and so it kind of smooths out after there. But the big jump is really the asset smoothing method, recognizing that last portion of the 2015 loss.
As those pieces drop off, it just creates some irregularities in the contribution. It's not that smooth because it's each year's piece over 5. So it's smoothing, but it doesn't necessarily play out when you assume all assumptions are met, which is what's underlying this, is we're assuming every single year in the future we have 7.5. That won't happen either. But for a short term, you know, it's a good glimpse. As Brian said, you know, we were very close because the return was almost 7.5, it was 7.54 this year. Had that return been further higher or lower, then we would have been, the actual would have been off more from that estimate.
So Doug and Paul, they're projecting that 8.33 million for 2018. It'll end here August 31 of 19. Are we on target making periodic contributions to hit that or exceed that?
I believe so. Paul, Sherry? Yes.
Yes, the city's definitely on target for that budgeted amount.
Okay, good.
Any other questions? We're going to kind of change directions here to wrap things up. I mentioned this earlier that we have a new actuarial standard of practice. We call those ASOPs. That was published recently that will be effective for a measurement date on or after November 1 of 18. So for you guys, it hits, so to speak, in the 2019 evaluation that we'll be preparing. We wanted to just basically make you aware of that, share a little bit of information. Obviously, the discussion will be expanding in the 19 evaluation. This ASOP has to do with kind of evaluating and disclosing the risk associated with funding a defined benefit pension plan. Okay, the actuarial profession feels a very strong obligation to the public good, so to speak, and there was some concern that maybe there wasn't enough discussion on that and that people didn't fully comprehend the impact of certain decisions, investment decisions in particular are the big one. So this is sort of a push from our leadership to get more discussion going with boards of trustees, councils, legislatures, plan sponsor type of people. So again, this is just one part of the discussion. We'll expand it next year in the valuation report and in our presentation to you as well. But we wanted to visit about this metric is called the asset volatility ratio. It's really just the market value of assets divided by covered payroll. Okay. Why is that important? Well, we get a lot of volatility on market value of assets, and whenever that happens, how are we recouping or making up for it? Contributions that are determined based on payroll. Okay, so it's kind of a measure of maturity, and the volatility on the contribution rate when there's variation in actual versus expected return. Okay, risk in this sense is actual experience that is different than what is anticipated by the assumptions. Okay, so certain factors that can contribute to the asset volatility ratio being higher, obviously, if you have more assets, and you're taking assets divided by payroll, the number's higher. Okay, you don't have to be a math major to figure that out. It's a good thing to be fully funded though, right? So try to stay away from a good-bad kind of evaluation when you look at this information. Again, it's just intended to help you get a better sense of the dynamic of pension funding and how it impacts your plan. Because how it impacts this plan could be very different from how it impacts, you know, the state patrol for Nebraska's plan or the state cash balance plan. Each plan is very unique in this way because some of these factors are related to the benefit structure, the demographics of your group, how long the plans have been around. So it's definitely not a one-size-fits-all. But again, it's not good or bad. A lot of these plans have been around a long time and they are maturing. And as they mature, the metrics change. You've got more liability in your retirees and your in-pay group. In some cases, we've seen shrinkage in the active membership, so covered payroll goes down. I mean, not so much public safety, we don't tend to see that, but some state retirement systems, we've seen that. All of these things are going to have an impact on this number, but again, this is very specific to each plan. So page 21, the asset volatility ratio based on the 18 valuation, if we just take the market value of assets, which was about 246 million, and divide it by the covered payroll, which was just under 47 million, we get a ratio of 5.2. Great, so what does that mean? Well, let's say we miss the return, the expected return is 7.5, and we miss that by 10%. So the actual return on the market value is a minus 2.5. What does that mean to the contribution rate? We all know that, you know, the way funds are invested in the stock market, we're going to have that volatility. And 10% variation is not unexpected at all. So what happens to the contribution? It's going to go up. And good, all right. But how much? And that's what this metric's trying to help explain. So if we miss by 10%, the asset loss, actuarial loss, compared to the 7.5 we thought we were going to earn, is 25 million. And that's about 52% of payroll. Okay? So in a really horrible world, if you had to make it all up at one time,
Let half the staff go.
plunk 52% of payroll in. Thank goodness we don't have to do that. And we have some actuarial tools that we use because we know there tends to be ups and downs in market returns. So we do have asset smoothing. Brian walked through earlier the 5-year smoothing, and then we amortize, you know, that experience over a 20-year period. So we have a couple of tools in the toolbox to try to stabilize that contribution. But as you look at these numbers, you'll see even with those tools, it can vary quite a bit. So again, that $25 million loss, if we amortize it over 20 years with no smoothing, it's almost 4% of payroll. Okay, it's significant. Now, we're gonna smooth, but guess what? Like, if we don't have high returns, it's eventually in 5 years, that's where we're headed. Single year, the first increase would be 0.79%. Okay? So it's just a way of helping you understand, and that first change would be about $380,000, based on this valuation. So what I'm trying to help you understand is if there's a swing in the contribution of 400,000, that's probably, that happened, 30, statistics is not what it should be. 2/3 of the time, it's gonna, standard deviation.
2/3 of the time, your
Yeah.
return will be between -2.5 and 17.5.
Right.
The other 1/3 of the time will be outside that range, so it could be even worse or even better. But yeah, so there's a good chance that it's between the -2.5 and the 17.5. About every 2 out of every 3
2 out of
years.
3.
Yeah, so again, not unexpected, but can be good or bad. I mean, again, it's variability, and that's usually the culprit from a budgeting standpoint. Even when it's good, contribution rate goes down, that's great, but that probably means at some point it's gonna come back up. So that's, I think, one of the biggest challenges with funding these is trying to create a funding policy that produces more stability in the contribution rate. And as we continue to work with you, we can talk about other changes that might help mitigate the movement quite so much. Obviously, if you have good experience, if you don't go down that far, then when it comes back up, you have a big an adjustment in your budget as well. So again, there'll be more on ASOP 51, both, covered payroll growth is a risk because we're making an assumption about that, and just because we assume doesn't mean it will happen. Longevity is a risk because benefits are being paid as long as people live. What happens if they live longer than what we're assuming? Those kinds of discussions we'll have more next year, but wanted to kind of just introduce this concept. This is sort of key, for just about every plan because they're mostly all invested in a similar manner.
Would you give the individual acronym letters?
Asset volatility ratio, that one, or which?
You said
Oh,
ASAP.
ASOP, Actuarial Standard of Practice, 51.
Got it right, okay, thank you.
And I'm happy to say not all 51 apply to pension actuaries, so they apply to all sorts of actuarial practice.
How about 15 more minutes?
Okay, and we're almost done, I think. So slide 22 kind of just wraps up, we've been through the valuation details. I think we told you, pretty much with the rate of return at 7.5, we didn't have a big liability gain. So everything was pretty much as expected, which is a nice thing to happen. We do have a deferred gain that'll help, be flowing through in the future. We'll see what happens fiscal year 19 return. I have absolutely I'm not going to put anything out there. It's 6 months away. We'll wait and see. That last bullet, though, future funding results are heavily dependent on the actual investment returns. And that's so true. And on the prior slide, you saw the way those returns unfold can create a lot of volatility, whether it's good or bad. So that's the challenge, the biggest challenge, I think, to manage is contribution volatility. So with that, we'd be happy to answer any other questions you might have.
Go ahead, Jay.
Councilwoman, yes.
And I'm not sure if you can answer this, but I'm pretty sure Doug or Paul could answer this. How often does the Police and Fire Pension Committee meet to reevaluate how their investments are going? In light of reading the Omaha Public Schools program and the tremendous loss that they incurred, how often does that committee meet and make the investment decisions?
Quarterly.
They meet quarterly.
We get monthly reports, and then we meet on a quarterly basis. We share those monthly reports with council as well.
And then how often do you look at maybe bidding out the plan for the oversight or changing?
For our investment advisors?
Not
Is that
for-
what you're?
Yeah, do they ever look at changing the investment advisors that they work with? Do they bid that out?
We changed that
Last change was effective January 1 of 2014.
Right, right. We were with Watershed to Elwell, you know, we were with Smith Hayes, thank you, and then to yeah. So periodically, we look at that. I think there has to be some, you know, mitigating reason to say we want a different advisor if we're hitting our marks and things such as that, but yeah.
I might, oh, I'm
Yeah.
sorry.
Go ahead. Go ahead.
I was just going to mention,
Go ahead.
because I forgot. We do have, periodically, we look at all the actuarial assumptions and methods that are used in the process, and we're due for a review of those. Again, state statute requires that every 4 years. So we'll be doing a deep dive into those, making some recommendations. Those new assumptions will be used in the 19 valuation. So just kind of heads up on that.
Now we have three
Yeah,
questions.
yeah.
What types of things do you see in the plan do you anticipate might change on the assumptions?
You know, it's sometimes hard to say until you've got the data in front of you. So I certainly wouldn't, and this will actually be our first experience study that we've done. Kind of inherited these assumptions. I think there was an experience study done almost right before we were
Right.
hired.
Correct.
And obviously, you know, the rate of return changed, but that was due to the plan changing, the COLA fund. We look at everything, so it, you know, it's just really hard to say until we
What are
have
some of the
the-
mortality tables? I know we had talked about that we.
Mortality tables, the payroll, you know.
Yeah.
Rate of return, those are all the things that are up for grab.
Everything's on the table, so to speak.
Okay.
There is a public plan mortality table that has been published. That's pretty recent news. Whether that's going to be a good fit, you know, for this group, public safety group, it depends. Again, this is our first time working with this plan, but with other plans, we have made adjustments to try to fit the actual mortality experience a little bit better with to better fit the expected to the actual. You don't have a huge group, so it is indeed harder to do that. So right now, we're using the RP 2000 table with generational improvement, which means we're anticipating people are going to live longer every year. So we're really using an RP 2018 table. Make it sound a little bit better, but there's been a new table that replaced that was RP 2014, and then the public table was just published in 18. So we will probably be looking at those tables to see if perhaps they are a better fit, especially if what's happened in the last 4 or 5 years indicates that maybe there were fewer deaths than expected. We like the generational idea where you're basically assuming that there'll be some improvement in the future, and we kind of bake that into the number, so to speak.
So that could increase the contribution rate because of longer payments?
Yeah,
Okay.
if people live longer, it costs more.
Okay. Anything on interest assumptions?
Inflation's at 2.5. That's generally where we're landing, so I don't see that changing. The 7.5 means it's a 5% real return. We tend to lean pretty heavily on the capital market assumptions that are used for each client's investment consultant. And to be honest, haven't seen those yet. I think those are due out. The 2019, I think, are coming out kind of any time now. So that'll be where we start. That was a little
That's
bit,
fine.
that's harder to take a guess.
Okay. My, a plan, we talk about different amortization schedules. So we've got the declining unfunded actuarial liability, and that's being notched down a year each year. So that, in the current year, is down to 26 years?
The legacy base. Mhm.
Okay, so the legacy, thank you. And then for the earnings, though, we're doing, that was on, the 20 years is on,
Experience basis. So the difference between the experience that's anticipated, whether it's assets or liabilities, and what actually happens when we measure that, it can be good, like this year we had a gain. It could be, I shouldn't say good and bad, but it could be higher or lower. So we could have a gain or a loss base. That period's over 20. So eventually, we're pushing to have a shorter period that we're recognizing variances in experience. That is definitely moving, that's a best practice, kind of in the actuarial community and the pension industry. Shorter amortization periods.
So, but right now, we're frozen at 20 years, are we not?
No,
That-
those
that-
go down one, each piece goes down one. I don't have, what slide are we on? There's a slide, Brian.
Or is the 20-year on new participants and the 26 is on the legacy?
The 26 is the legacy, so next year that'll be 25.
Right.
And the base that we set up in 17 is 19 this year, it'll be 18 next year. There. So this is the layer. So next year when we do this table, the first line is 25, the second line is 18, the third line is 19, and the new piece will be 20. So each piece is over its own closed period. So at the end of that period, it's paid off. So no open or rolling amortization.
Which we,
And again, that's a positive funding policy. I think we're moving in the right direction, you know, in 6 years, everything will be 20 or shorter.
then my other question would be maybe for Paul or something. Looking at last September 1st and the value of the assets up till the end of January, where are we at? January is the greatest month in 30 years.
Yeah.
But before that, we're some.
December was.
I haven't actually done the January numbers yet.
Okay, well then do through December. How
Through
much have we
December,
lost?
About a -7.5.
Okay. And I think January in some cases was 6% or a little more. But if we've been kind of leveling out that 7.5% assumption, that would give us September, October, November, December, January, 5 months. So we should have been up maybe 3%.
Well, you take the year-to-date through December number and add in what is the January return, which I don't know what that is yet. But it's positive. I don't know how much.
Okay.
Well, truth be told, a lot can happen.
Yeah.
And in our
Before
investment mix,
8/31.
My question is, should I be worried? That was
Long-term. It's always long-term.
always long-term.
I can't
Look
answer that.
short-term, yeah.
on our
Concerned but not worried.
Going back to what Jane was asked about on our committee meeting and so forth, there's been a shift in types of investments, and could you maybe describe that? Because we used to be really pure stock, and we've gotten into what, real estate investment trusts and some other things. Could you describe a little bit, or is it still fairly heavily into the equity markets, the stock
Well, we're
market?
we've moved towards a more diversified portfolio that helps with these ups and downs, whether it be real estate, whether it be the large cap, small cap, what have you. So, again, those are put forth, and I think you get that on a monthly basis as well, as we share those with you to see what our investments are like. So I think, if there's other information you want, we're happy to share it. But we've worked over the last several years with Elwell, formerly Watershed, to diversify that portfolio much, much more to help with some of this, ups and downs, the volatility of the market. And I think we've accomplished that well.
Last weekend I read a book called Surprising Science of Meetings, and they encourage you to cut meetings off early so people would have time to go to the bathroom and do other things before the next meeting. So I'm going to say thank you very much for coming.
Thank you for having us. We appreciate it.
Thank you very much.
Thank you. Perfect.